Hi folks, welcome to this special video. Do read the disclaimer. Today we're going to talk about what if the exchange defaults. So this came about in our previous video also where we were talking about the silver exchange and how shortage in the physical market can cause a situation where an exchange can actually default. So neither is this video claiming that exchanges will or can default, but the mechanism of how the exchanges work is being discussed here, and the potential that especially in commodity exchanges, because see what happens in equity exchange, everything is anyways digital, so there is no essentially shortage of what is being traded, and everything is cash settled, whereas in a commodity exchange everything is not cash settled, and we will basically discuss what potentially can go wrong. So we after that video we got some queries from you, and we are basically doing this video to answer those queries. So one query was that if the default happens, will the price crash or melt up? Is this scenario fundamentally different from negative crude oil event that happened post COVID? Are physical holders of silver better positioned than paper holders, ETFs and futures? So we will try to discuss each one of them one by one. So let's understand the price dynamics in an exchange, and especially the physical commodity exchange. So what is happening in the exchange? Buyers and sellers are coming together. The exchange is nothing but a platform where both buyers and sellers are registered. They have put up some margins, and they are, let's say, let's only consider futures transactions here. So they come together and transact. The buyer says, I'm willing to buy at this price. Seller says, I'm willing to sell at this price. And they match, the exchange matches their intents. And basically that trade goes on. There is a margin, you know, debit or credit on each account every day. And at some point, when the futures contract is about to expire, the buyer has to tell the exchange that whether he wants to take delivery or he would get it cash settled. So in normal situations, most people don't want delivery because it's a headache to collect the delivery from the exchange custodian and then take that delivery and store it, and then perhaps the next time you're selling a futures you will have to give that delivery. There is a logistics and inconvenience cost to it, so it is usually paper to paper continues. You buy in one future series, and then once that future series is coming to an end, you buy in the next series and you close this one on paper and you get cash settled. I hope you're following what I'm saying. Now what happens, and typically, like for instance gold and silver deliveries, they would be as low as like 1% of the open interest. So if there are 1 million contracts open, then you perhaps will have 1% of that getting delivered. So there are very very few sellers, and there are very very few buyers of physical delivery. Now there could be a situation of a market dislocation, like a flavor of which we recently got, where physical delivery was not available. So sellers will have difficulty giving that delivery to the exchange. And in case a larger number of buyers start to demand delivery, then the exchange can't get that delivery from anywhere. It only has the sellers to deliver the delivery, or they can hold an auction process and try to get it from open market. So what can happen potentially is that, let's say 20% of buyers say we want delivery, and only 5% of sellers are offering delivery. So the 15% unfulfilled delivery demand, the exchange will have to hold an auction and try to get it from open market. If they are not able to do so, technically the exchange has defaulted, because they have not been able to fulfill their obligation to provide delivery to the buyer. And what will the exchange do in that case? They will do a cash settlement. So whatever was the last traded price on that contract, they will tell the buyers, your trade is closed at this price, so please take this price, and the seller will also be closed at that price. The actual market price, which may be at a huge premium to that, will the buyer will not get the benefit of that. So let's look at several such consequences. If you have seen the previous video, you now very well know what is contango or backwardation. If not, please go and see that video. Backwardation is when futures market flip with the spot price trading above the futures price, uh, and which was happening very recently in silver, where spot price was 25,000 rupees above the futures price. So the delivery is highly valued. So you can get a futures contract for 1.5 lakhs, but the delivery is happening at 1.7 lakhs, right? So there was a complete washout of deliveries from the market, and there was a huge premium to be paid if anybody wanted immediate delivery. Now, if you get into that kind of a situation, it is inherently bullish for the underlying metal, because there is no delivery available, and everybody knows that there is no delivery available, and everybody who's holding the delivery backs off and is not willing to give the delivery at all, and that causes the physical market to shoot up like a nobody's business. But what happens to the exchange? Because the exchange is not able to deliver, it is very bearish for the people's confidence on the exchange. So fear of non-delivery causes, a massive sharp melt up in physical prices, and it will also cause a lot of open interest to suddenly start to close, because people don't want to be in a market where deliveries cannot be taking place, and it's a complete price disruption that is happening. Now, if we compare the situation to what happened in April 2020 with crude oil, uh, just to give you a sort of a different flavor of what is happening somewhat now versus what was happening then, are these are two different opposite things that were happening. So if you recall from the previous video, in April 2020, crude oil had a physical glut. There was so much crude oil available and nobody to take delivery because COVID had struck and nobody wanted crude to be taken, but the oil rigs were running and they were producing massively every day, and there was no demand for it, so there was a glut of crude oil. And in futures market, basically, um, people were cutting their position, and the futures market continued to collapse, and it went into negative territory actually. So prices for physical delivery were collapsing there. It was not going up because there was excess of delivery, and buyers were backing off. They were rejecting delivery. They had nowhere to store the oil. So that was the crude oil story where contango was happening. And here is the backwardation in silver, where physical shortage happening. Buyer wants the metal. There is no metal available. Cannot get delivery, and prices for physical metal is surging. So these are the two different, aspects of dislocation that we have seen so far. Now, when we look at physical versus the paper markets, there are many nuances which you need to really get your hands on. So in a paper market, just like I said, let's say you were holding a huge position of silver on the exchange, and now this dislocation happens, and futures prices remain stagnant, but physical prices go much higher. So there's a dislocation between the futures price and the physical price, and you will get cash settled at the exchange at a massive discount to the physical price, even though you were holding a position of long in the paper market. So paper players at some point of time can get shortchanged by them getting into a cash settlement, by the exchange forcing a cash settlement on them, and the exchange forcing a cash settlement on them would technically mean that the exchange has defaulted because the buyer wanted delivery, they are not able to give delivery. In the physical market, however, there is zero counterparty risk, because when you hold the asset, I mean, it is not dependent on anybody else's delivery or pricing. You holding the asset, and that is, the price of it is determined by the market. Now, paper market is more popular because it is very liquid, and there is ease of trading. You know, one second you can buy and 1 second you can sell. You don't have to, store. There is no cost of logistics. So from every single way, paper markets are very liquid, very desirable. But as they say, there is no free lunch. If you're getting something that is too good, there has to be a flip side also. And the flip side is that risk scenario. It may be 0.0001% risk, but that risk is there that what you're holding you may not be able to get. It's a promise basically, and it's not in your hands. Physical markets, however, are more illiquid. They're harder to buy and sell. Storage cost, insurance, exposure to margins of wider spreads, and all those things are part of the physical market. So while most of the world trades in paper, and the Wall Street and all these financial geniuses have mastered the art of financialization of everything. So if there was, so much silver available in the entire world, they have created an entire financialized silver product, which is like hundreds and thousands of times of the total silver that is available. And I'm taking silver as an example. It could happen to any commodity. Now, what will happen to other products? So, just like we saw, as soon as there was dislocation, ETFs started to suspend new subscriptions, and NAVs were trading very off from their INAVs, uh, and still discount to the underlying spot price. So, had you been holding physical asset, you would be able to sell at the spot price. But if you are holding ETF, maybe you will not be able to get what the spot price premium is, right? Or some buyers who may come in now may be buying, the NAV much above at premiums, and later on, as we saw, those premiums may disappear. So physical markets are not dependent upon all these other products creating the price for you, and physical markets basically are in the best position to demand the right price for their metal. Now, if we see the physical paper to physical ratio uh, in the markets, it has gone up dramatically in the last few months. So, gold and silver, and this is based on the CME exchange report, are now roughly at 10.9% delivery and 4.3% on gold and silver, which used to be less than 1% not so far. So suddenly now demand for physical has gone up on the exchange, and so far there is no issue because there have been uh, decent supplies matching that exchange also. But if this demand were to go 20%, 30%, then will the exchange be able to deliver? That is something that we don't know. Now, what happens, if the exchange goes bust, bust in the sense of it is not able to fulfill its promise, then a lot loss of confidence happens in paper commodities, and it may, bring in a lot of new regulation, and all those things will start to happen, and it may also basically become a snowball effect on all other paper products that may be there, where new subscriptions may be getting frozen, or perhaps some ban on buying or selling may happen, and so on and so forth, and the real world price of physical silver or any metal would basically melt up until these supply chains will normalize. So has any exchange defaulted ever? Not really. There was a couple of instances in 1976 and more recently in the 2000s where some potato contract was basically the exchange liquidated positions, and there was a Norwegian trader who defaulted on a margin call, and basically that was it. So far we have not had a situation where exchanges have not been overwhelmed. But can this history be taken as a gospel truth that never an exchange can default? Because I've shown you in numbers how, at least for a short period, there can be defaults that are possible. As soon as bigger number of buyers start to demand delivery, immediately sellers will have to offer delivery, and which may or may not be available because the construct of the exchange is such that they are trading into thousands of times of the actual metal available. Now, how will speculators trade in that scenario if an exchange fails? If it is not able to provide physical goods or assets, then basically exchange, as I mentioned earlier, will use a cash settlement. They will pay the buyers. The buyers will not be completely, devoid of their profit, but they will basically lose the difference between the paper price and the physical price. And if that becomes larger and larger, then that will be a problem for the buyers. So far, that has never happened, but the idea remains that if somebody tries, some large entity, let's say Warren Buffett is sitting on $350 billion of cash and he says, I want $350 billion of gold tomorrow, the exchange will collapse. So a large entity, if a large, 300-pound gorilla comes into the market and demands delivery, let's say China does it tomorrow, that I want 5,000 tons of gold this month, then the exchange cannot handle it because there is not enough physical metal available for that kind of dislocation. The price will have to move dramatically to try and maintain that equilibrium, but most likely buyers won't receive delivery and they won't get their true profits from that. So this is basically a theoretical concept largely, um, but The idea is that what has not happened till today should not be brushed off as that it cannot happen. So if we continue to leverage the system in the way we have leveraged it, someday this is possible, right? Just like the debt burden of the US, which is $38 trillion right now, it was perhaps less than 20 just few years back, and it was $1 trillion just a couple of decades back. So it is continuously going up, and there is no free lunch in this world. So at some point, it will have to crash. This entire construct will have to crash because it is unsustainable right now, because it is, we are seeing one day at a time. We are like the frog in the pan syndrome, so we don't really feel it. But it will happen one day that, the system will demand, the equilibrium that is required for this to happen. So a lot of extreme short term volatility can happen, physical value can melt up. uh, Physical holders will be in a better position to protect their wealth for sure. See, unless you are having some sort of a advantage versus others, you will never be better off than others. So physical holders, while they're taking all this pain for, buying physical, holding it, storing it, paying insurance, so they are accruing all this cost, right? So they, when it is required, when ultimately it is required, they will be the ones who will be better positioned to protect their wealth. The convenience, of course, right now is with the paper market. Let us know in the comments how you like this video. What are your thoughts on any silver exchange collapse that can happen? You can watch this other video also, and certainly I'll be looking forward to your comments. Do subscribe to the channel. Do like and share these videos. Thanks. Bye.